Welcome to a new edition of Accounting 2301 Notes with your host, Professor Naragon. We're coming into with Chapter 5, and we're bringing in inventories and cost of sale. Here, we build upon Chapter 4, but we're dealing more with how cost of sales is actually done, and dive deeper into inventory, which right here we're going to learn 3 methods, and this is how most companies actually run their inventory. It's going to be one of these 3 methods. We start off with the basics. We're going to go with an example of a t-shirt company. The company sells t-shirts for $100 a piece, and they assume the purchases following. Now, since we're tracking inventory, not all inventory is going to be the same price. In Chapter 4, we had that scenario. All inventory costs the same, basically around the units. Here, we actually have specifics, and we're going to deal with the sale of these kind of inventories the way they go. So R3, we have first on May 1st, we have 1 unit of 45, that cost us 45 to get. May 3rd, cost us 65 to get that same unit. And on May 6th, cost us $70 to get that unit. So if I sell 1 unit on May 7th and collect $100, how much would the expense of cost of goods sold? Okay, that's the question we're going to ask. Especially when we go to companies, we got to know how their inventory is set up. And there's 3 types. And you're going to hear me reference mostly their acronym on the first 2, then actually say what it means throughout the rest of this interview. But first one is known as first in, first out, or FIFO. FIFO happens when we take the first product that we got, and that's going to be the first one that goes. Simple as first in, first out. So for us, when we sold on May 7th that 1 t-shirt and collect the $100, again, this is my revenue. So we have 100. Cost of goods sold is going to be the $45. It's the first one that came in. First one that leaves, the cost for that first one was 45 bucks. So my gross profit is $55. That inventory is always going to be what's left. For first in, first out, it's still going to be the May 3rd and May 6th. Add them together, that's where we get 135. And we're going to get into all these methods throughout this whole chapter. This is what we're built upon. So be prepared. The second method that we're going to end up exploring is last in, first out, okay, or LIFO. Most companies will figure more into this particular one with LIFO. It's a good tax advantage. So as you can see, net sales does not change across the board. We still sold it for 100 bucks. Not going to change. The thing that's going to change is cost of goods sold. Here, we take the last unit. So the last unit we actually bought was May 6th, and that cost us $70. So with that, we're going to take 100. Now our cost of goods sold is now that $70. Means we made a profit of 30 bucks. And then, again, add what's remaining, and our inventory is 110. Alright? So, not too bad there. Again, last in, first out, we take wherever we last bought. Here we take wherever we first bought. Okay? And the third method that we have is known as weighted average. Weighted average is as simple as put. We're going to take the total units we bought, which is 3, because each of these was 1. We're going to add up all the costs, as you can see here with the fraction. So we have a cost of 180 divided by 3. And we know right now our average per shirt cost-wise is $60. So we take that as our cost of goods sold now. And you're going to notice this. Weighted average will always fall in between these two. Okay? If this is a really out there number and it's higher or lower than this, you may need to double check the math. Okay? But again, now $60, our gross profit would be $40. And notice that inventory is just $60 each again, just times 2, because we still have 2 units. And that's going to be our inventory. Again, we'll get into more in depth with all 3 of these as we go on. Even your homework is going to have a little bit of difference to this. Now, there is also a 4th type that we're not going to get really involved. Your homework does get involved with this, but in your notes or in this video, we're not. And that's known as specific identification. Now, specific identification basically is anything with a barcode that we can go directly to that product when it's sold and tell you exactly how much that cost us. So great examples of these are basically VIN numbers. Again, any VIN number that's placed on a vehicle, we can really find it very quick, and we're able to say this is how much it cost us to build it, or how to purchase it, and this is how much we sold it. So we can go really specific. Here with these methods, I mean, we can go a little bit more specific, but this gives us an option. Basically, we can pick which each other one. So no really big thing there. They're still basically a broad. Here, I can go specifically to that code. So other things that would have this, you can look at basically computers, cell phones. Most electronic devices will. Game systems. I mean, guns. Guns all have identification numbers. We can always trace. These are ones that we can specifically trace to an individual. Here, I can pick any shirt, whatever lasts. I don't really specifically trace. I don't have a barcode for it. They all have the same. We just assume that we sold the last shirt. I mean, if you actually look at Walmart, these probably all 3 are mixed up in that same bin. And we're just going to go, well, since I can't specifically say we sold the $65 shirt, I have to take whatever method we're using, last in, and just say the last cost. Here I can go. So good comparison of these methods is how businesses really want to basically make either a profit or a little bit of savings on tax. So the best thing is look at the cost. If the older costs, which are the cheaper prices, if they're rising and business wants to keep their inventory under a LIFO method, which basically means lower ending inventory balance, but also lower net income, which is good. If it's the other way around, we would want to do FIFO. FIFO will end up being lower. Basically, what we want to do is, I'm going to be honest, LIFO tends to be the best one because usually prices are always rising. We don't see a fall in price very often, so mostly they're rising and most companies choose LIFO. Again, this is mostly due to taxes with this, because they're showing less gross profit, means they actually do pay less in taxes, and this works great. The one thing that's here is that the IRS and the government says you must choose one of these inventory methods. You must keep that inventory method. I can't go year to year, so I can't go in 2018 and into 2019 and say I want to change because the other one gives me the better option. No, you have to keep it the same. If you do decide to change, you have to put in a documentation why you changed. And believe me, that's more of a headache than other things. So, but 9 times out of 10, LIFO is going to be your best. So when you get into the real world, you're probably going to see a LIFO if they have an inventory system. It's just how it usually goes. So again, another good graphic here. Basically tells you what happens to the oldest costs and the recent costs. Again, we'll get into more of that. Now, a lower cost of market, LCM. So usually we generate inventory, we record it at cost. Sometimes that's not always the case. Now here, we're going to do a brief and intermediate. You actually get this a little bit more. Here it's just knowing what it is and the basically conservatism principle. We want to keep basically inventory to basically the market price mostly. And it's because certain things like LIFO takes the oldest cost. Well, that's not always going to be the actual cost of market. So we may actually have to raise it a little bit. We'll make an adjustment. Same thing here with FIFO. It always takes the recent cost. That may be too high. So again, we would actually have to change it up. So we usually want to take the lower cost. It's more conservative. It works best for us. This way, we don't have to worry about overshooting or undershooting. So with this, we like to take the lower of the two. We compare. So as you can see, they're comparing right here. Cost, market, total cost, total market. We take the total market. Here, cost, market. Cost is a little bit lower. We take the lower cost. Again, we're more conservative. It's best to be conservative than not. But we usually don't do this until like end of the year if we want to adjust our inventory to the cost. And again, once we adjust that, that will affect our cost of goods sold with that. And that's basically all we really need on this part. You're not going to see it too much. Again, this is going to be more intermediate accounting. Again, your book just wants to kind of go, hey, here it is, but don't worry about it. We'll get back to it. If you're an accounting major, you'll get into it. Here, we just want to say, this is what it is, here it goes. So you're going to see that, again, as you've seen before. The book wants to just briefly go over something, or basically you don't have too much to worry about. So, accounting for inventory, again, we're using the perpetual inventory system. We're not using the periodic. Again, periodic, once a year, once a month, that's when all the inventory is done, mostly physical counts. Here, we're doing it, again, basically periodic. When it comes in, we immediately record it to make sure what our value is. Now, they show an example right here, and this is something you do have to kind of know with, first, our dates. We'll have 3 columns for inventory when we write it the longhand. Again, nowadays you got software helps, but of course you got to know what's happening in the software. And then we have cost of goods sold, inventory balance, and basically this is the pattern that we go. Starting on August 1st, we have a beginning balance in inventory. This is usually what's happening at the end, but say we just purchase inventory. We purchased 10 units at $91. So we have 910. This came over from last month. On August 3rd, we decide to buy additional 15 units at 106. That equals to 1590. Notice inventory balance. Since this is FIFO and LIFO, we have to watch out. Notice that they are adding the two together, but they keep them separate. The reason why, again, is because we take the cost of these units as they were when they came into us. So on August 14th, this company, this example, sold 20 units. Notice that they're again separated. First off, we only have 10 units at the 91. Since it's first in, first out, we take that 10 first. We have an additional 10 units. Remember, we sold 20. So at 106, we take 10 from this one, leaves us with only 5 units left at the same price. And now the 10 units is completely gone that we originally had. On August 17th, we decide to buy 20 more at a new cost. Again, add everything out, keep them separated. August 28th, again, 10 more units, keep them separated. On August 30th, we sell, looks like 23 units. So since we're selling 23 units, we look again at the first one, which we only had 5 at 106. That's not going to fill 23 units, so we got to go to the next one to fill up the rest, the remaining. So 5 minus 23 is 18. This one has at least 18 units, so the rest is going to be at the 115 price. So again, we times both, add them up, gives us to 2,600. Now, you're going to be asked, 1, what is my cost of goods sold for the month of August? Well, all I'm going to do is take these two totals and add them together. This gives me 4,570 for my cost of goods. Here, you're also going to get the ending inventory balance. This is what's ever on the last transaction of that month, what's left in inventory. Here, we only have 2 left of this original 20 at 115. We still have the 10 at 119. So our ending balance currently is 1,420. Okay, that's first in, first out using the chart. So again, all this right here belongs to that. So last in, first out. So with this one, you're looking basically at the opposite. Same scenario. So we're going to do the same scenario and you're going to see the difference that goes on. Usually the two purchases are beginning balance and purchase. Nothing's going to change. It's always when the first sell happens. So first sell, again, we have 20 on August 14th. Since this is last in, first out, the first one we look at is going to be the last item. This time it's 15 at 106. Well, 15 doesn't get us to 20 yet. So 20 minus 15 says we have 5 more units that we got to get the cost of. So we look at the one above it, which is the 10. So 10 at 91, we take it, 5 at 91, 455, there's our 20 units, there's our cost, and now our cost is 2,045. Here, again, you see it, we have 5 left at 91. So right now our inventory is 455. So of course we buy a couple more. We do the same steps, 20 at 115, 10 at 119. Notice that they're always separate. Do not combine dates. Okay? Every date is separate. This is a common mistake that I have seen, that you just want to add these all together. No, gotta keep them separate. The reason why, again, is traceability. If I get one of these charts and I go, the numbers look off, I can go right to the transaction and go, hey, this is what happened and we need to fix it. Alright, so August 30th, we again have 23 units. Notice this. Again, I go from the last one. Last one that came in was the 10 at 119. That does not get us to 23. but we can take out 10, which says we got 13 units left. So I get to take the whole 10. Now I go and take the 13. Well, look at the next one, 20. So 20 at 115. Well, I can take 13 from here, still have units left. So I'm going to take the 13. And there's my 23 units at their cost. And that's my cost right there when I add them together. So cost of goods sold now is $4,730 for the month. And look at here. Notice that the 5 at 91 is still there. It's going to probably stay there for a long time. Okay, so don't worry about it. That's usually how it happens in last in, first out. And then our 7 at 115. Now, again, the biggest thing with the last in, first out is that eventually products are going to get obsolete and you will have to work them out. But we're going to get more into this as we go. Again, we're going to do a couple examples and so forth and so on. But if you do compare the two graphics, notice first in, first out, 4,570. Here, it's a little bit more. But on inventory, this is more, this is less. So again, it's just the way that they want to basically examine the product. Alright. So now this brings us to our control of inventory. Alright. We're going to get into internal controls as we move further. But we're going to get a little bit into this. There's 3 documents that goes along with inventory that we want to keep track of. As accountants, we have to keep track of a lot of stuff. We're going to have a lot of documents. And inventory is a good one to have a lot of fraud in. So we have inventory controls associated with inventory. And we got a cool little cycle that goes along. And it's basically starting off with the purchase order. So with the purchase order, we're basically going to have whatever department, they're going to go, hey, we need this inventory purchased. So we're going to send a purchase order. With this list what kind of inventory, how much, and as accountants, we're going to physically check the receipt, make sure everything's good. The next thing that we should get is a receiving report. This receiving report is basically when we actually get the shipment. We get the shipment in, we have a physical count of this. You also get a document usually from that says these are the amounts of inventory that got shipped. Please verify, and they should match to our purchase order. I shouldn't have more inventory than I actually purchased, or less. So we're going to check those. Again, this is a check and balance thing. So shipping passes, we got exactly what we want. This has a cost to it. Purchase order says how much it's going to cost. Next thing you get is the vendor's invoice. Vendor's invoice is going to represent the amount that's owed. This should be about how much we purchased, the same amount. Should actually also kind of report on the receiving report also, because this is what came in. Well, every now and then things change. One, the vendor may say, no, you actually purchased this amount of inventory. Well, we check this before we issue out a check to the vendor. Again, check all the documents, make sure nothing's different. And any difference that we have as accountants, we have to immediately put a red flag. This red flag says somehow one of these documents is showing different numbers. We must investigate to see what's going on to help stop actual fraud taking place. Again, this doesn't stop all fraud, but it helps to actually see who authorized, who received, who billed, and to make sure everything was running properly. So it does take a little time with this as we go on. Now, in a physical control of inventory, which is only allowed through personal access, we may actually have only once a year where we take a physical count of inventory. If anybody worked in retail, you actually have this go on right before the end of the year or the beginning of the year, when basically tax season is rolling around. We're going to take a physical count of inventory, and it should balance to what's on the balance sheet. If anybody works in retail or any other inventory place, you already know this is probably not going to be. So if inventory is missing, it must be recorded as an expense at the time of a physical count. So basically we're going to adjust inventory and make it an expense. Again, you're going to get this more in the intermediate. We're not going to do too much of an adjustment of inventory in this course, but you will get that in intermediate accounting if you decide to take that as an accounting major. Just know that the concept does happen. We do have to basically adjust it to the physical count once we make one there. Usually this is shrinkage of inventory. So it actually happens quite a bit. Our goal is trying to prevent as much as we can. Now, I noticed this says chapter 6, but this is actually chapter 5 practice quiz. Again, you can actually change this as you go. So this is chapter 5. Their practice quiz are, how they say practice quiz, basically our practice problem. So we have a retail firm. They've hired us to do their accounts for inventory and post the necessary journal entries. Unfortunately, this one cannot afford that computerized system that was nice and fancy, that makes everything work so much easier. Instead, the manager just says, I'm uncertain to use LIFO or FIFO, and instructed you to use basically both ways. Okay? He gives us the data for January. Now, we're going to have to watch out. There's two prices here. One is the cost price. Now, cost price is what we purchased for. So again, this is buyer. If you want to look back at chapter 4. Price, this is seller. So again, we're dealing with the buyer and the seller. So we have to watch out which way we go. And of course, we got this little chart that we have to basically give out how much we have. But the only one that we can really do is sales right now. And sales to us is basically these $30 times whatever the units. So 70 times 30, 40 times 30, 20 times 30. So if we take 70, basically you can just add them up. It's still the same thing. Plus 40, plus 20, and times that by the good old number 30, since they're all sold at the same price. We don't have different ones. If we had different, then we would go more individually, 70 times 30, 40 times whatever, 20 times. But our sales price will stay the same. Right now it's 3,900. Again, because of this recording program, I can't go to a calculator and actually show you the calculator like I can do on the homework. So good thing is, watch the homework video that's going to be posted, and basically from there you can actually see how the calculator calculates as we go. But sales is easy. That takes out this one. So as soon as you do the sales, if it helps you out, cross out this price or do whatever you need to do. Just eliminate this. This is no longer valid for us. Okay. because honestly our charts don't really care anymore. Our goal is now to get cost of goods sold and ending inventory. That's how FIFO and LIFO tables work. So here's our tables, and again I'm going to go back and forth while explaining these, and we're only going to put the cost. Again, as you can see, they're broken down to 3 sections. One is for only purchases, one is for cost of sold, and one is for inventory. So let's look what's going on. Again, we're going to do FIFO first. So with this, on January 1st, our inventory starting off was 100 units at $20 per unit. So here, we will put in our date. Of January 1st. We don't have a purchase. We didn't buy anything. We didn't sell anything. So our only option is inventory. 100 unit cost is 20. So our current inventory, beginning inventory, was $2 grand. Alright. Next one, January 4th, we had a sale. Okay. So we had a sale of 70 units. Again, I don't care about the price when we're doing these charts because I have nothing that deals with sales. But we did sell an item. So since we sold, and if you remember from chapter 4, when we're the seller and we sold something, we have cost of goods sold that goes with it. Again, cost of merchandise sold is the same thing as cost of goods sold. They're just interchanged. So here, we're going to look at how many units. We have 70. Well, 70 goes into 100. Yes. So we can take the full 70. So 70 units times 20 equals 1,400 that we sold. We no longer own 70 units. Well, that means because of this 100, we lost 70. We basically take 100 minus 70 and should say we have 30 units left. The unit cost does not change, so it's still 20, and it just means we have now 600 left in our inventory. So we go next. Next item, we purchased on January 10th 80 units at a cost of 21 bucks. So here, again, put our date. Since this is a purchase, we put under purchase the 80 units at their cost of $21. Here, they are not the same cost, 2 different costs. I have to keep them separated. So yes, I know there's no space in between, but you need to do this. If it helps you out, put a space in between. Remember, this is a table, so if you're taking it from the actual Word document, you can insert spaces. So if that helps you out to separate what's going on. Okay. Here I'm just going to keep it going as the way it is. So no more spaces. We're just going to go. Okay. So now in my inventory, I have 30 units at a cost of 20. I have 80 units cost of 21. Here's where we're going to get a little bit of changes between, again, FIFO and LIFO. So, next item, we sold on the 22nd. So, again, we sold. So I'll put our date. Since we sold, we're going to deal with cost of merchandise. How much did we sell? We sold 40 units. So we're going to look at our first item in this list. Well, first is 30. That doesn't make it to 40, unfortunately. But since it doesn't make it to 40, we know at least we can take the full amount of the 30. So the amount is right there. So 30 at the cost of 20. Well, since I need 40, I know taking 30 from 40, I have 10 units that I still need to find the cost for. Lucky for us, we only have this 80. So we're going to take 10 units from the 80 at the cost of $21. So again, 10 times 21 gives us 210. Here, our 30's gone. All we're left is what's left of this 80 after we subtract 10, which should be 70 units, still at its cost. Again, even if you hit red or highlight, there's nothing here because we lost that. And it's always good to have that space. Again, it shows you what's missing. So if I took 30 minus 30, should have 0. If I have 80 minus 10, should have 70. Okay. On the 28th, I decided to sell 20 more. We only have this batch right now. So this one, basically sell 20 at 21 for 20. Take 70 minus 20. Says we have 50 left of our units at the 21 price marker. So we only have 1,050. The last part, on the 30th, we purchased 100 units for 22. So again, since it's a purchase, it only goes under the purchase column. So 130, 100 at the new 22 price point, 2,220. I didn't sell anything, so I don't have to worry about this one. Here though, I have to worry. One, I still have my 50. So the 50 comes down. Now we can put the 100. Okay? Always make sure you bring down whatever you have in inventory. Here we're just lucky that we have these. So again, if it helps you to basically separate these, you can, as the dates can get confusing. But remember, each transaction is its own thing. So if I have 50 from the 28th, that 50 is still carrying on to the 30th transaction. It has to be there. Okay? So for cost of goods sold, to get the numbers we need in the chart, you will have to add up these amounts. So this column right here, right here, gets added. Do that little green, but all those numbers get added. That's my cost of goods sold. So if you add them all up, you would actually get to 2,630. Next is my ending inventory. My ending inventory is going to be the total of whatever happened to my last transaction. So for this, I have two different price points on my last transaction in 130. So I'll add those two together, which looks like 3,250. And that's my ending inventory. So again, to get gross profit, we're using the same formula in chapter 4. You're going to take your revenue, which was the sales, minus my cost of goods sold. So you should get 1,270. Remember, gross profit equals basically net sales minus cost of goods sold, or cost of merchandise sold, however it's read. So you gotta remember that part, and that will give us our gross profit. Now let's look at LIFO. So LIFO, I can actually go through the same methods here. I can use this same chart, but we're going to notice a few things different. Alright, so on January 1st, same thing. We have our inventory of 100 units. at a cost of 20. On January 4th, we did sell. We only have one batch of type of inventory, and that's the 20. So here, nothing's going to change. Still the same thing. We have 30, 20, 600. On the 10th, again, nothing changes between the two. Okay, it's only going to change once we sell when we have multiple inventory quantities with different costs. Okay, so here we go. On the 22nd, we decide to sell that 40. Now we're going to look at the last one. So which one's on bottom? Well, 80's on bottom. Does 80 cover the 40? It does. Mostly if you want to check, just take 40 from 80, and if there's still some inventory left, we're good to go. So we're going to have the 40 and the 21 at the cost of 21, so 840. Notice that when we fill in, we still have the 30, 20 at 600. That didn't get touched, only the 80. So 80 minus 40 gives us 40 at 21. Now again, this is the concept that you gotta get. It's always going to be the last one with LIFO. So I'm only going to look at that one. Again, if it helps, insert a column above just to separate out the two, to remember that they're different transactions. We have to keep inventory separate. So on the 28th, we decide to sell 20 more. Well, again, this 40 covers 20. Because again, if I decide to subtract it all, it'll be fine and dandy. So since it covers the whole 20, again, we have 20 at the cost of $21 to get us our 420. Here, 40 minus 20, since we're dealing with the last one. So it has us 20 left of that inventory at $21 on the cost. We have 30 at 20 at 600. Again, that did not get touched. But here, since we still have two inventory base, when we make our last transaction on January 30th, purchase of additional 100 units. So insert another column above. So with this, again, it kind of separated them 2 pages, but with this one right here, notice this. I want to go ahead and delete this one. So I can get it back up here. Okay, so notice this, that now we have 3 going on. One, we still have the 30 at the 20, because we didn't really sell this one since we're on LIFO. We have the 20 at 21, and then we have the 100 at 22. Notice the total right here is 150 units. Notice the total right here, 150 units. The units do not change. They're going to still be the same in either method. The only thing that's changing is how much cost is associated with those units. So here we have the same thing. We're going to find our cost of goods sold. And of course, our cost of goods sold is adding up this column only. Okay, after we've done 70 times 20, 40 times 21, 20 times 21, and boom, that's going to give our cost of goods sold. And again, now that we have 3 on our last transaction, this is going to be my inventory, ending inventory. So wherever's in this column in the last transaction has my ending inventory. So I don't total all this up, just the last one. So for that, if I did that, we're going to get cost of goods sold at 2,660, which does verify cost of goods sold should be higher than FIFO. And that means our inventory is going to be less. Notice that's pretty much the same amount if we take the differences. This went higher by 30 bucks. This went lower by $30. Tends to happen if you compare the two. And then of course we find our gross profit, which again is taking our sales minus our cost of goods sold that we find out, and that gives us $12.40. So that's using our example. Again, you don't see weighted average, so I would strongly encourage to watch the homework video, or while you're doing the homework, pay attention, because weighted average is going to be used. You're probably going to see it either on your quiz or on your homework while you attend the class, but weighted average will be around. So the next lecture video will be over chapter 6, which is about reconcile bank statements. But that's it for chapter 5. Again, the hard concept right here is understanding the methods. This table is the best part. So again, what FIFO, you always take the top before you take the bottom until you use up the top. LIFO, just the other way around. Take what's on bottom, use that up before you hit anything above it. So if this was the next transaction was a sell, I would end up using the 100 before I touch the 20. If the next transaction was a sell, I use the 50 with FIFO. So just be careful, watch out, and that's it for chapter 5. If you have questions, again, you can leave a comment or you can send me an email real quick. It all works. Okay? See you next time for the next video, next lecture over chapter 6.